Hi everyone, so this is a really quick flipped learning video and what we're going to be doing in this is just looking at some adjustments that we did see all the way back in booklet 1, but I just want to do a quick flipped lesson on this just as a recap. So this page is in your work booklet. It is on page 73 and this again is looking at these extra information that could appear in your financial statement for sole traders. So the first one that we're going to recap on are drawings. Okay, so what actually are drawings? Well, if you remember correctly, drawings refer to when owners, so in the context of the sole trader, we would call them owners, okay, not partners, as we would in a partnership. So it's when the owners take out assets for personal use. Okay, now a common misconception with drawings is that it's just cash that the owner might take out, but it could be beyond this, and we'll see that in a few moments. Okay, so it could be any sort of assets, okay, let's make that slightly broader, any sort of resources for personal use. Now this is related to the business entity concept, okay, because by accounting for drawings what we're making sure is that the business's transactions are kept separate to those personal transactions of the owner. Okay, so the first type of drawings that we're going to look at are private expenses. Okay, so this is, for example, if the owner uses the telephone or a company car for personal use. So technically this would be an example of drawings because the resource has not been used for the generation of revenue or profit, okay, but for personal reasons, then this should be recorded as drawings in the statements. Okay, so for example here, let's say that we have telephone expenses for the year and they amount to £600. The owner though has been using perhaps the company mobile phone for personal calls, etc., and they agree that a fair proportion would be a quarter of that £600 to be treated as drawings. Okay, so what I'd like you to do is just pause this for a moment and just think about what proportion of that £600 should go on the income statement as an expense of the business, okay, and what amount should be recorded into the drawings accounts. Okay, so hopefully you've paused, you have a little think. Okay, so 3/4 of that £600 is a business expense. Okay, so that would be £450 being recorded as an expense on the income statement. Okay, and in the drawings account it would be £150. Okay, now the double entry to this would be in the bank. Okay, so apologies, I'm not using my pen here, I left my pen at home, so I'm just using the actual draw function, so it might not be as clear. Okay, so we know under duality that every debit has an equal credit, not the clearest A, I know, I apologise. Okay, so in the income statement we would have an expense. Okay, that would be debited in the income statement. Okay, and the double entry in the bank laughing at my writing skills here, okay, would be 450. Okay, in the drawings account we would be debiting at £150 because under duality in the bank account we would be crediting 150. So just so you satisfy that double entry aspect of the transaction. Okay, now another common type of drawings is when the owner takes out goods for personal use. Say for example if you owned a convenience store, then it might be quite likely that you perhaps drink a drink from the fridge, okay, perhaps you take a chocolate bar off the shelf or a piece of fruit, and again this would be classed as drawings, so we need to make sure that this would be recorded in the financial statements. Okay, so what's really important that we do here is we actually adjust the right figure. When we are taking a drawings of inventory, we take it from the purchaser's figure. Okay, a common error is that people take it from closing inventory, but there's two reasons why it's not taken from this figure. Firstly, closing inventory is in relation to a specific date. It's the end of the financial year. Okay, so it's really unlikely that actually the date at which we took that drink, that chocolate bar, that fruit was actually on that date. Okay, so just make sure you are taking it from the purchaser's figure, okay, not closing inventory. And then on the statement of financial position, okay, our drawings figure will be increased. Okay, now the other transaction that I just want to recap on, and you did see this back in the concepts chapter, so earlier on, okay, is that you are maybe dealing with goods that are bought on a sale or return or basis. Okay, now what I'd like you to do is just pause this video and see if you can remember what a sale or return actually is. So just pause it, just have a think about this for a moment, and then we'll go through it together. Okay, so the way that I like to describe a sale or return is a try before you buy. So this is when a supplier sends out inventory to a potential customer, and potential is really important here. The sale has not yet been agreed, so that they can have a look at the inventory. They might put it on their shelves so they see if customers actually want to buy the inventory. Okay, now what's important here is who actually owns the inventory, and it is the supplier. Okay, the supplier owns the inventory. What sometimes can happen though is that when the supplier does their closing inventory stock take at the year end, because the inventory is not on their premises, because it is out with the potential customer, that they overlook it. Or vice versa, it could be that accidentally the potential customer records that inventory as their own because it is physically on their premises, but they can't do that. Okay, they don't own it. Under the realisation concept, it is still the supplier that owns that inventory. Okay, so just pause that for a second and just make some notes here. What do we mean by sale or return? Okay, and if you need a bit of help with that, look back into your concepts chapter because you've got a little handout that has a perfect definition. Okay, so just to summarise, the legal position on this is that when with a sale return transaction, it's important to remember that the sale has not yet been agreed. This means that the legal owner of the inventory is the business supplying the goods, as the potential customer has not yet agreed to purchase, so does not own them. So therefore, they should not be included in their inventory stock take. Okay, how does this link with the realisation concept? Well, if the business you're accounting for has sent the goods out to the potential customer, if the business we're accounting for is the supplier, the inventory belongs to them. And even though it's not physically on the premises, we should be including it in our inventory valuation. On the other hand though, if we're the business that is the potential customer, okay, whilst we have that inventory on our site, okay, we should not include it in our inventory stock take because we have not yet agreed to buy. Okay, so hopefully that's just given you a little bit of a recap of these two important adjustments that come in. Okay, you can now fill these in on your summary sheet and we will view these together in class when we go back to putting together full financial statements. Okay, if you still have any questions on this, make sure you comment on the Director Study Help feed, okay, or alternatively, make sure that you are asking questions. Thank you.